Welcome back. You're watching HFO-TV.
Let's give a warm welcome to Nick Bley.
All right, good morning. So if you've been part of the Portland apartment market for the last 5 years, it's been like a day at the beach. I mean, rental growth has been outstanding. It's been 4% or better for the last 5 years. The last 2 to 3 years, we've been seeing 7 to 8% rental growth. Very, very strong. Expense levels have been relatively moderate. What we're seeing is probably in the 3 to 4% range. And what that's done, the combination of those two, we've seen NOI growth of about 10% on most of the properties that we look at. So super strong. Apartment owners have been loving the market. Cap rates. Cap rates used to be, 2-3 years ago in the 6.5% range. They've been coming down into the low fives. Some of the most recent deals I've looked at have been in the 4.5 to 4.75 range. So definitely investors are anxious to buy Portland apartments. What has that done to value appreciation? If you've been in apartments, it's almost doubled in the last 5 years. So people have done very, very well in apartments. And interest rates have helped that. I mean, interest rates have been very stable. Most of the time, they've been in the 3.5 to 4.5 range for 5 to 7 year debt. So very, very good. And this is the question that I probably get asked the most with all this value appreciation is, from our client, hey, what LTV can I get on a new loan? And so the banker's response, what we have to kind of talk to our clients about is, hey, it's all about net operating income. And from a banker's perspective, it's about, hey, the cash flow that comes off of that property and with the sustainability of that cash flow over time. So what I'm going to talk about a little bit today is kind of the big macro factors that we see as affecting cash flow down the road. One of them is jobs, and our economist here, a lot of my numbers are very close to yours, so I feel good about that. I have, we get these from Moody's, but, unemployment has been down. It's down for what we're forecasting for this year at about 3.5%. That's down from 4.8% last year. So unemployment's down. Job growth is down a little bit, just as she said. We saw it come down to about 2%, but still that's a pretty healthy job growth number. And I concur with her. I'm hearing from a lot of our clients that a lot of the reason that we're not seeing the job growth is it's qualified candidates. And so the market doesn't have enough qualified candidates to continue the job growth. So I do think that's a healthy thing in the market, and we should still consider to see reasonably good job growth. Supply and demand is one of the most important things here. And as she talked about migration, so last year, roughly 30,000 folks migrated into the Portland market. This year, we're forecasting about 40,000. So that generates about 20,000 new households. That's super strong. That is really driving the market. And in terms of apartment units, we are seeing historical supply of apartment units. This year, we're forecasting around 5,000 units, but about 4,500 of those should be absorbed. So that's relatively in balance, which is pretty good. We're seeing some slight upticks in vacancy, but nothing terribly concerning at this point. This is probably my favorite chart that I have on here. And what this tries to do is look at the overall housing supply in the market. So we're combining single family and multifamily. And kind of the big things to take away from the top chart here are the 20-year housing supply level there. That's that kind of orange line going across there. And so that's the 20-year average. And we're just kind of coming up on that with the total single family and multifamily supply that's coming to the market. So we're meeting the 20-year average just now. But the biggest thing that you see out of this is a lot of that is coming from multifamily. Proportionally, multifamily is making up a bigger and bigger proportion of that. And a lot of that has to do with the cost of doing single-family housing and the cost of single-family housing. Multifamily housing is a cheaper option for people to rent. So we look a lot at cost to own versus cost to rent. And that bottom chart there shows the cost to own versus cost to rent. The black line is what it would cost to get your average mortgage. The red line is the cost to rent. And you can kind of see those two things are diverging. The cost of single-family houses have been going up at about 60%. So it's very, very difficult for a younger person to afford a single-family home, and they're going into multifamily homes. That's what makes us really feel pretty good about this market. Affordability. So I've gotten some questions on affordability. How does Portland rank with other markets? So we looked at an index here. This is the average salary of people in the professional services and business sector, and how does that compare to Class A and Class B rents? So you can see Portland there is about in the middle, lower middle of the chart there. And what it shows there is, Portland's for a Class B apartment is 21% of the average salary, and for a Class A, I think it's at 26% or so. It is the lowest West Coast city. And if you start going down the chart, you have Seattle beyond that. You start getting down into the Northern California and Southern California cities and New York. But I think this is one of the reasons that you see the in-migration to Portland. It's a desirable city to live in, and it's one of the lowest cost cities when you compare it to other cities for its apartment rent costs. So I think that's interesting there, and I think you're going to continue to see some of the in-migration. Millennials are making up a big portion of the population renting in Portland and across the country. So across the country, millennials make up 41% of the renters. In Portland, they're renting 52% of the new apartments. And I found this probably to be the most interesting part of this, which is the millennials are kind of cohabitating before they get married at the rate of about 37% today. And I think this ties into what's happening with affordability. People are cohabitating to be able to afford the higher rents. Interesting enough, that number was 10% in 1987. So we're seeing a lot of doubling up of people going into apartments. And interestingly enough, the other thing we look at too, we've seen in downturns, is that doubling up factor that happens when you have a downturn. People kind of roommate and they find people. But I think that effect may be muted in a future downturn because it's already happening today. Rent growth and vacancy. So we look at this. This is a couple of things that we really keep an eye on. And rent growth has been coming down a little bit. What you have here, and the reason I put this chart up here is it's kind of a class cut of rent growth. So the dark blue line is what we call 4- and 5-star apartments, and the light blue line is 3-star apartments. And what you're seeing is the rent growth is coming down on the higher end apartments. And I think that's natural. You're going to have, when affordability is an issue, the higher end are probably not going to have the rent growth that the lower end does. And you're seeing the vacancy there on the bottom chart, the vacancy in the higher end, according to CoStar, is up at about 10.4% right now. So a talk wouldn't be complete from a banker without a little bit of discussion on rates. So where are rates? What do we see with rates? So rates over the last 5 years have been fairly consistent, kind of in this range of about 100 bips or so. You saw an uptick there in 2014. We saw another uptick in rates in late 2016, right around the election. But for the most part, rates for apartment lending have kind of stayed in this area of about 3.5% to 4.5%. And even when we've seen those upticks, there's been so much competition in the market that rates, for the most part, have not gone up. What's happened is the credit spreads have come in. So it's been a very, very good time to lend, and I would say it's still a very, very good time to lend. Those are outstanding rates from a historical perspective. Going forward, I do expect there's going to be a little bit of pressure on the upside for rates. The bottom chart there shows short-term rates. So that is the 12-month MTA and the 6-month LIBOR rates graphed out. And as you can see with what's happening with the Fed funds, those rates are starting to push up. Eventually, those are going to start to have some effect on our long-term rates there. In addition, you've been probably reading that they're going to start releasing QE, or effectively they're not going to be renewing those bonds. So that will have an impact on the longer end term of the rates too. So what is the forecast going forward? I still think it's sunny at the beach, but there are definitely some clouds on the horizon. As I talked about, the job market's still strong and favorable demographics continue to support the apartment market. Cost to own versus cost to rent definitely favors apartments. Rental growth will slow, so that is one thing we're going to continue to watch is what's happening there with rental growth. And while interest rates probably will head up a bit, I don't think they're going to head up at any type of steep pace. I think it's going to be relatively stable for a while. Unless we see some type of a credit event out there, I think we'll have relatively favorable rates. Things to watch out for. New supply is coming on at historical levels. So we have to continue to watch that in context of what's happening with job growth. Rent levels are starting to push affordability limits, and so you're seeing that in the higher end of the market. And expense increases could outpace rental growth. So as we talked about a little bit, the job market is very, very tight, and we may start to see some wage increases there, particularly on the lower end of the spectrum, which could have some effect on the bottom line of supplies that apartments use. Prices based on cash flows are way up. As I talked about, cap rates are down at 4.5%. That's super low levels. So prices right now are pretty high. Cap rates over time have been correlated to interest rates. As interest rates rise, cap rates tend to rise. So that could create some pressure on prices. And then the other thing I'd watch out for is tax reforms. So you've all probably listening to what's happening on the tax reform side. 1031 exchanges are being called out as something that may go away. There's also some talk around different depreciation levels, so we'll see what happens there. Thank you very much. Hopefully you gained a few insights out of this.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.